Welcome everybody. I am thrilled today to interview Pete Stavros of KKR, who is a leader in putting together transactions where employees participate and has had great success with the companies that they have invested in and the returns that employees have earned. I want to start by just asking Pete to give us just a little bit of a detail of his background, and then we'll go into sort of how he came to look at his strategy as one that could be helpful both for employees and investors. Peter?
Okay, thanks, John. Thanks for having me. Good to be with you today. So in terms of my background, I grew up in the suburbs of Chicago. My dad was an hourly construction worker. I've talked about this in the past. You know, he two things he didn't like about his job. One was it was difficult to build wealth or savings on an hourly wage alone. You know, he made about $15 an hour by the tail end of his career, operating a road grader, which is what he did for 45 years. And then the other thing he didn't like was the lack of incentive alignment with his employer. You know, he always felt like if the sole way he and his colleagues were paid was by the hour, then he ended up fighting over hours all the time, as opposed to focusing on doing the job right, on time, to a high quality level. So, you know, things that I grew up with around strikes where people were fighting over hours, and that left an impression on me. My dad always dreamt of profit sharing or ownership or some way of aligning incentives, which is where a lot of the impetus for me wanting to pursue this came from. As folks may know, I worked on an ESOP, as luck would have it, in the mid-90s, which I thought was totally fascinating. And that's what I spent my time studying at business school. I published a paper 22 years ago on ESOPs and why they had kind of declined in popularity for companies at scale and in private equity. And could there be a resurgence of that? Could it still be relevant? And I've continued to, you know, I think ESOPs are great. And if there was a way to resurrect their activity for bigger companies and in the private equity community, I think it'd be great. So that's remained a passion of mine. And then when I got into a leadership position at KKR 12 years ago, started experimenting with non-ESOP ways of sharing ownership broadly, which is you know, what I've really been focused on specifically for the last 12 or so years.
There's a lot of people who, you know, have been part of the ESOP world for a long time. Is it possible to share that ESOP two things? Is it possible to share the ESOP company? If you can't, that's fine. But would it also be possible somehow to tag or make your paper available? Because history is very important in understanding the path of employee ownership in society.
Yeah. So the ESOP was called Gleason Corporation. It was a public, I believe it was at one time 100% ESOP, and then was a public company with a minority ESOP. I mean, this is like almost 25 years ago, so I don't remember exactly the details.
That's okay, but okay.
But there was still a minority ESOP in the company, and the ESOP wanted liquidity. You know, as John, as your ESOP colleagues will know, you know, one of the challenges is successful ESOPs run into liquidity constraints.
Right.
And the ESOP wanted liquidity, and, you know, so we were a source of liquidity for the ESOP and for the family. And then what went along with that was the public got liquidity as well. And then on the paper, you can find it online. It's called Private Equity and ESOPs from
Excellent.
2000, I think. And it was in I want to say the Journal of Finance and the Journal of Private Equity, if I remember that right. This is a long time ago.
Great. I kind of a believer in history to help understand today. So there you are. You're a partner in KKR. It's 2011 when you began to employ this in your investment. That's what the press would say.
2010, I think.
Okay.
2010, 2011. One of those. It's right around then.
And you're looking to do better. How is it that you came? I understand the history. I understand your father. I can understand how that would motivate you. And your training. How long did it take you to figure out how you wanted to implement it? Or, tell us a little bit about that. And was it well received among your partners when you came up with this idea, or did you have to do some internal selling as well?
Well, I didn't ask anyone. We just started doing it. And then, after we had done this a number of times and had some good results, started talking about it more internally, started talking about where it could be relevant elsewhere, not just in one vertical. This started in the manufacturing investing vertical. And in terms of your question of like, how did this come about? Why did we start it? In a typical company, the employee engagement level is low, deeper into the organization, and the turnover rate is high. So,
right,
there are, as I'm sure people will know, if you look at something like a retailer, it's not uncommon for a retailer to have 100% annual turnover. So they're literally refreshing the entirety of the workforce every year. Distribution companies are not far behind. It's common to see 70%, 80% turnover. Amazon would be probably 150, 200% is my guess. And then, even manufacturing, it's not uncommon to see 40% turnover and engagement scores that are really in the toilet. So if you have the style of investing that I had when I was running the industrials group, which was very much focused on driving operational change, if you want to drive productivity, reduce scrap, improve customer service, improve quality, you really can't do it without the hourly workforce, because in a manufacturing company, the hourly workers are sometimes 80% of your employee base. So if they hate the company and they're not engaged, you're not going to achieve your objectives. So it was not hard to see the opportunity. Like anything in life, it's all about execution. This is not employee ownership is not a complicated idea, and it's not a new idea. It's just not often done well. And it's all about execution. It's all about leadership. It's all about, how do you translate? If it's just ownership, that's just compensation. If all you do is hand out, and I don't care if it's an ESOP or not, if all you do is hand out stock, you're not going to change the culture. You're not going to change how people feel about their role in the company. It's all about, sharing information, sharing decision-making rights, operating in a more transparent manner, soliciting input and genuinely acting on the input. It's all of that stuff that is going to move the needle. It's not, if it's just equity, it's not gonna move the needle on the culture of the business.
So key to that would be your management and their culture, right? Because you have to have the management team that's going to implement those cultural behaviors that will make everybody improve and feel connected to the organization. Was that a hard sell at the beginning, or did the idea float as well with your management teams as it ultimately did with the employee populations that they were working with?
So I agree with what you're saying. It is all about leadership. And if you could get inside of the leader's brain and assess whether that person genuinely cares. So do they genuinely care about the well-being of the people deep in their organization? Second, do they feel like they can have an impact? There's a lot of people who care, who look at the problems and say, I just don't think I can do it. I mean, we have 15,000 people in this company in 80 different countries. Can I really move the needle on how they feel? And can I really move the needle on turnover? So, and then the last one I would say is related to whether they care, is like, do they think it's their responsibility? There's a lot of people who do care, but they're like, it's kind of the government's problem. It's not really business's problem. So if you could get inside of a brain of a CEO and assess those three, you determine whether you've got a leader who's going to make this go. In terms of your question of was it a hard sell, I'd say no. And when it was a hard sell, it was the wrong person.
Gotcha.
So, if a CEO is kind of pushing back of, oh God, people will never understand ownership, they'll never value it, can't we just give them another $1 an hour in wages? Then it's usually the wrong person.
What about consultants when you started out, or communications folks, in order to sort of help the CEO? Did you look outside to people who kind of can talk to, what rank and file employees and help communicate the idea, or your communication strategies all generated internally?
the communication strategies, I would say, generated internally. But we always leverage heavily outside resources. So if you talk about something like culture and employee engagement, that really has to do with supervisors. So if you can assure, if you can get every supervisor feedback and make sure that supervisor acts on the feedback, you're going to improve culture.
Right.
So there's a lot of analysis around, where the cultural problems are, where the turnover is high, where the engagement's low, and then getting those supervisors training. We brought in outside resources like LRN, a well-known guy called Dov Seidman. If you haven't read his book, How, it's worth a read. And we brought Dov in to basically facilitate discussions between shop floor employees and supervisors, and
Right.
to work through what the issues were, and to problem solve, and to train people to listen. Supervisors are not trained to listen in manufacturing. It's a little bit run like the military. You kind of do what you're told, and your input's not often welcome. So I guess a long way of saying, we rely heavily on outside experts who have figured some things out and can lend us some tools and some frameworks. But when it came to communication, we looked around. I kind of felt like we could do a decent job on our own from a communication standpoint.
Right. And I could say I'm on the board of a company, and our weak link is supervisors, in because they don't have the skill sets. They're nice people, but it's to your point, they don't look at their job as we're talking about how we would like a supervisor to look at their job.
Yeah.
And the older they are, the more the harder it is.
Yeah.
Which I'm going to go to your latest case where you realize value. A question: is your workforce been multi-generational in that your demographics have they been biased upwards or downwards, or would you say you have a good mix of ages in your workforces in terms of participants?
Manufacturing skews older, so
right.
There's not a lot of young people who want to go into manufacturing, or working in warehouses or driving trucks. A lot of the so-called blue collar jobs are on average the workforce is pretty old. So where this effort started in our firm was in manufacturing, which skews older, but now it's everywhere. We do this in software companies and media companies and financial institutions. And so it's now, I'd say, very broad based, but where the heritage of it in our firm is in manufacturing, which skews older.
Okay, maybe you could talk about Minnesota and talk about sort of, what you were looking at when you bought it. What were the circumstances that made you decide this was a good time to move on? How are the employees participating in the company, and how are they rewarded?
So this company called Minnesota Rubber and Plastics, it was a family business. They sold a stake to a private equity firm. We then came in to buy the business and kind of cash out the prior ownership. Our investment thesis was it was a good business with operational improvement potential. So there was a lot of excess scrap, and there were opportunities in quality and on-time delivery and lead times and innovation. And so the idea was to kind of further invigorate the corporate culture, share ownership with all employees in the business, and try and drive improvement along those dimensions that I mentioned. So, it only took us a few years to drive the margins up almost 500 basis points, which is a lot, and drive growth.
What percentage was that? Like 500 over 10%, 500 over, how big an increase?
Yeah, 500 over 20. So started in 20 and ended in the mid 20s.
Okay.
And drove a ton of growth in the business and a ton of innovation. And so in terms of your question of what made us think now is time to get out, once we try not to time exits. Like sometimes, we held CHI for 7.5 years. We held Ingersoll Rand for almost 10 years. this one, when we've done 80% of what we came to do, and if there's interest from a buyer at a fair price, we exit.
Right.
So as long as the markets are stable and the price seems reasonable, we try not to say like, now's the time to sell or now's not the time to sell. So there was a corporate acquirer who wanted it. We had done 80% of what we came to do. And so, we sold. It was that straightforward. And then in terms of the participation of the employees, it depended. If you put aside the management team, so take aside
Right.
the top,
Yeah.
few layers of the organization, for everyone else, people earned, between 100% and 200% of their annual income, which is, pretty good. I mean, I pitch a lot of ESOPs, and a lot of, 10-year ESOP models only get to 100% of income over 10 years for the employee base. So to make 100 to 200% over, over 3 years is pretty good.
Yeah, and I think that that's what makes, to me, your concept unique, because I work with a ton of ESOP companies, and they don't have the kind of leadership at the top. And I'm, expertise, people thinking about value creation that, a firm of experts like yours brings. And I think, that's sort of, if I were to look at the marketplace in general, I would say there's a lot of well-intentioned people, but less skilled than, or thoughtful, even though they're all good and hardworking. So what you bring is a little unique in that, because your skill set, is spectacular in terms of what you bring and experience.
Thank you.
So,
We're trying, and it gets into a little bit of like, what is ownership? I talked about this earlier, but it's not really about the stock. Ownership is a mindset. It's a different culture, which is the key to unlocking some of these things.
I don't, if you can't answer this question, it's fine. I was thinking about it. You have a couple of new sets of owners. Did any of them continue with the same kind of reward system, or did they then impose their own reward system on the assets that they acquired?
So there's 3 different ways we exit companies. 2 of the ways there's a continuation of our program, and one of the ways there's not. So if we take a company public, we basically create a system where this lives on forever. So Ingersoll Rand, for example, 16,000 workers in 80 countries, they all have ownership, that'll live forever. If we sell to another investment firm, they tend to maintain the program because they don't want to break the culture. The toughest one is when a big corporate buyer buys a company. And this is applicable whether it's our model, whether it's an ESOP. It's just very difficult for the corporate to say, I've got 50,000 employees over here, but I'm going to do something, this acquisition, I'm going to turn over our whole reward system inside out because of this acquisition. So, whether that's, like I said, a company like Dynetics, which was a great ESOP that sold to a corporate acquirer and they had to blow up the reward system, or in our model, when we sold Minnesota Rubber and Plastics to Trelleborg, a big corporate in Europe, unfortunately, the same thing happens, which is they change the reward system to be consistent with what they have in place.
Okay, and okay, that's great. And so now 100, when you're looking at a company, because this is part of value creation, you're always thinking of applying these models to your acquisitions. Because is it right for me to say that you think it gives you value add that's unique, comp and makes your returns better for your investors? Is that sort of another way for me to look at it, so to speak?
Yeah, we think that, it's the right thing to do, and it's also a good thing for investors. So it's one of these very hard to find win-wins where if it's done well, everyone can be better off, not just workers, but the company, the community, investors. It can be good for everyone.
I mean, and we need it. I mean, people don't understand. We worry about our country's debt, but our country's retirement financing is as problematic as $31 trillion worth of debt. Why don't we end up talking about the not-for-profit organization that you set up and lead as the chairperson? What was your idea behind it? It's been up a year and a half. What is your plan for it to help? in your mission that you started at your organization?
Well, it's only been up 6 months, so we're
Oh,
still,
okay,
we're very young.
okay.
But we've got,
Apologize.
by the end of the, I don't know, I want to overpromise here, by Q1 of next year, let's say, I think we'll be pushing 100 different organizations that are a part of it. And the idea is to be a source of tools, templates, frameworks on how to do this well. So your comments, John, about how do you drive culture, operational improvement, change in a company, not just by handing out stock, but by impacting culture. There's some things we've learned about that over time. And so we want to be a source of that for others. We want to be a convening where we can get CEOs together, CHROs together, investors together who want to work on this problem of how to share ownership broadly in a company and make it well understood and have it impact culture. So we want to bring all those people together to work collaboratively on this problem. And then we want to try and create, more awareness of employee ownership and a broader movement around it. And a lot of that, I think, relates to storytelling. When we can tell these stories of, okay, we just sold this company, here's 2,000 people who now have 100% or 200% of their income in equity, in a payout at the end of a journey, or sometimes more. I'm sure you saw some of our other examples where we had a company, truck drivers made $1 million. I mean, and I know that's not as uncommon in the ESOP world if people stay for 30 years, but in our world, it's
Right, because of the short term
yeah.
nature. On average, do you have an average? I don't want to say you're opportunistic, but market conditions change and you get to your goals early. So is it really dependent on progress when you kind of
It
might?
is.
Okay.
Yeah. Our average hold period in our main fund is about 6+ years.
Right.
We have a longer term vehicle where we hold things for 12 to 15 years.
Oh,
So
okay.
we're a lot longer term oriented than your typical investor.
Yeah, I understand that. So in terms of, is there a way for, if the other question is, our markets are segmented by size. You said, you have to have, for you, because of your investment philosophy in dollars, you have to have some scale. Is this new organization going to provide, when you get to the lower middle market, let's say a company worth $100 million, will they sort of have a focus on that part, or is it more for some of the size companies that you've been working with?
I think eventually the idea would be we'd have companies of all sizes. Right now, when we only have 15 people in the nonprofit, and we're just getting going, we're probably starting with bigger companies with bigger employee bases and who can be a source of ideas and experiments of their own. But sure, the idea would be longer term. We've got hopefully a huge organization with tons of members who are all contributing and all learning from each other around this idea of, again, how do you implement this stuff? How do you make it understood? How do you communicate it? How do you leverage it into a more engaged culture where people are less likely to quit?
And the question is, how do you think it's taken off? You know a lot of CEOs, other people, just given where you are, and do you think this is an idea that people will, that will carry weight, that people will see could be very beneficial if appropriately implemented? Do you see that kind of enthusiasm, or are people so worried about so many different things that it's nice, but it won't motivate them as much as you would like because of the world we live in?
Yeah, it's a mix, I would say. There are some who I think are really passionate about this and they see it through both lenses of, hey, this could be good for the company and also could really help all these workers. And then there are some who are stuck in an old way of thinking, which is, oh God, hourly workers, they'll never understand equity. They'll never value it. This is never going to work. So you hear a lot of nevers from the people who aren't as enthusiastic about it.
No, I was going to say, I'll use a New York Giants analogy only because you bring in management that's 40 who can sort of understand new ideas. It's a little bit easier to implement change than have people whose know a different world trying to implement change.
Yeah, I do think we've got a unique moment in time where, there used to be a lot of frictional cost to changing jobs, and there wasn't the shortage of labor we've got today. And now there's really no friction, and everyone's short labor, and so labor's in high demand, and people are searching for ways to, as one of my friends says, find stickier glue for humans. How can we make humans stickier? And so some of that is mission of the company, vision, values, why people want to be associated, and then part of it's ownership. If you're an owner, you're less likely to quit. And again, for me, owner is a philosophy, not just, hey, I have stock. It's the
Right.
broader philosophy. When I say owner, that's what I mean.
Before we end, I just want to say the National Association of Corporate Directors had a meeting on the topic you just addressed, and they said, for the first time over the last 24 months, this is a board topic that occurs frequently in board discussions, and one of the 1, 2, or 3 things that boards are very concerned about in terms of retaining and training employees in a world where it's very hard to do. So, you're right on in terms of a solution.
Yeah.
Anything else to add at this point in time? It's been great talking with you. But I think we covered what I wanted to cover. Is there anything you want to add, or are we good?
We're good. I appreciate having the chance to talk to you, John.
Okay, thank you very much. And everybody, I hope you get the time to listen to this video and conversation with Peter. Thanks a lot.
Thanks, John.